India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, good morning.
Hi, good morning, Prashant. Good morning, Nigel. And what a weekend, right?
Yeah.
I mean, there was so much happening this weekend, from sports to the grand wedding. And of course, the market has been at all-time highs. So, I mean, it's been great.
Well, and overnight, if you woke up on Sunday morning, the big headline was the shooting of Trump, right?
Yeah.
And that seems to have swung the US presidential election in his favor. As it was tilted in his favor.
I mean, that it was just quite scary, right? I mean, imagine if it was 1 inch or 2 inches here or there. I mean, we would have been talking about absolutely different, a very, very different sort of scene this morning. But, well, those are pictures right after the shooting in that rally which took place. Whatever you might think of the guy, that is Donald Trump, ex-president of US, and of course now fighting to be president. I mean, I think that one image of him right after the shooting, getting out and sort of, essentially mouthing the words, fight, fight, fight. I think it's just I think that's the one image which perhaps will be seared in the memory of voters when come November. Of course, I mean, it's advantage Trump in that sense, especially post this. So dramatic visuals, dramatic sort of incident coming through over the weekend. Markets, of course, here are nowhere. I mean, it's because November is too far out and they're not starting to really trade the US elections in that sense. But I think this is going to be important and meaningful later this year. Let's just sort of rewind the clock and tell you what you need to know as we begin another week. This is a holiday-shortened week, of course. Wednesday is a market holiday, but nevertheless, it's filled with lots of earnings. I'll just start with the one sector which really led the rally on Friday, which is IT services. Now, massive move. The index itself ended about 4.5% higher, and that basically propped the Nifty up back to new all-time highs, right? Now, I looked at all the constituents of the Nifty IT index, 10 stocks, and all 10 were higher, and the rally was anything between 3 and 7%. Honestly and frankly, I was scratching my head and wondering, well, what is going on? Because if you look at it, earnings estimates have changed only between 2, 3, 4%. That's it. I mean, there has been no large-scale big earnings revision. You heard the commentary from the TCS management, and that remains largely unchanged. I mean, they've said that FY25 will be better for FY24. They've said that for the last 2 or 3 quarters. And of course, they've also kind of maintained that, clients are focusing on high return on investment projects and kind of pushing back on discretionary projects. I mean, that also remains the same. But markets are markets. I mean, they tend to look at different things differently in different points of time. I think the big rally essentially is on the back of 3 things. One is under ownership in IT stocks. People are, of course, on the hunt for new ideas, which are, the list of those newer ideas is lesser and lesser as everything is done very, very well. IT is one sector which is not. The other one is, of course, is US rates. US rates is also a very big factor. And of course, I mean, there is hope that there will be some sort of earnings turnaround, real business turnaround later this year. And I think that remains a hope, which is fine. But I think at the margin, the bigger underlying driver seems to be, the above 2 at this point in time. Just one other interesting bit, which sort of I found, that stocks of other global IT services companies, not listed here, but listed in the US, EPAM, Globant, Cognizant, they all rallied between 5 and 7%, 5-6% last week, right? I mean, over the last 1 month, they're all up between 10-12%. So this is, what we saw, of course, post the TCS earnings is perhaps also a rub-off on what's happening globally. I'll come straight to US data because, US rates, if there are big influence, we've got to look at the data. Data has been supportive. I mean, jobs number, the CPI number, and you look at the PPI numbers on Friday. That's a core producer price index, and the Michigan inflation expectations both actually were softish. And that supports a sign, and that kind of is the market betting on the fact that Fed cuts are certainly coming. Of course, there is the July FOMC meeting, but I mean, we're looking at the September one where perhaps we'll see the first one. Nasdaq was up 0.6%. The 10-year yield was down 3 basis points. The dollar index was down about 1/3% as well. This is the change on Friday. U.S. markets have done very, very well. And of course, the setup across the board on dollar, etc., is positive here. We will hear, there's an interview which Fed Chair Powell will sit down for later tonight at about 10 o'clock tonight, Monday evening. And I think headlines from there will be watched in terms of especially the imminent July FOMC. Depends on how much he wants to comment. Earnings in the U.S. will also kick off, and there's about 8% of the S&P market cap which will be reporting. Just to circle back and finish this off in terms of levels, Nifty broke above the previous high of 24,461. For a while, we've kind of maintained that, you basically are looking at a higher equality level, which is 25,500. I mean, we'll see if you're on track for that. But you're essentially in blue skies, uncharted territory. Bank Nifty, it gave up the entirety of its intraday gains on Friday, which isn't a good look, which isn't great news in terms of sort of tracking this day on day. On the downside, the Bank Nifty should not break below 51,750. That's the first level. And of course, on the upside, a break above the high of 53,357 will confirm further upsides. And I'll just leave you with this data point on the India inflation. June inflation number, which came out Friday evening, shows essentially the need for a hawkish RBI and why the RBI governor in our interview as well essentially said that, we're not near the comfort zone and perhaps rate cuts, etc. needs to be. I mean, it'll happen, but of course, no timeline as such. Of course, along with that, you also had the IP, the industrial production numbers, which confirms that the economy remains in pretty healthy shape. Give Nifty up on your screen. It'll give you an indication about 84, 85 points higher is what the start is looking like. Sonia.
Oh, absolutely. And, this is a big, big week for the market, right? I mean, you mentioned that it is a truncated week, but there's so many cues to watch out for. So our eyes are going to be on that. Of course, this is the last trading week before the union budget on the 22nd of July. So that is going to be the big focal area for the market. But apart from that, this week we kickstart with a lot of Nifty companies reporting their earnings. There's Bazaar Auto that comes out with earnings tomorrow. There's Infosys on the 18th. There is Reliance that wraps it up on the 19th, which is on Friday, and then followed by the union budget on Monday. So it's a big, big week for the market. A lot of stocks in focus this morning as well. There's IRDA, which could really lead from the front after seeing a very strong AUM growth of 34% in Q1. And then you have large caps like HCL Tech as well as Avenue Supermarts that came out with their numbers. HCL Tech maintained its FY25 revenue guidance of 3 to 5%. So no major positive news, but no negative surprise either. And that's something that the street may definitely like. And Avenue Supermarts saw a good improvement in its gross margins, both year on year and quarter on quarter. So these are a couple of heavyweights that will be in focus. But for the markets, right, the sensex and the nifty are now up for the 6th straight week. So we have big gains under our belt. And there was large buying from FIIs on Friday as well. I mean, FIIs bought over 4,000 crores. We're getting additional support from the global markets as well. You have the Dow that hit a fresh all-time high on Friday, above 40,000 on the Dow now. Huge milestones hit over there. The Dow has in fact gained 6% in 2024 so far. But look at the move on the S&P 500, 18% rally in 2024 so far. So big moves coming in there. So all eyes will be on how this week shapes up, and of course large events to watch out for.
Well, that's right. The sense you got on Friday was that in fact, the Nifty is prepared now to move to higher levels, and maybe that range has moved a little bit higher. And now all eyes are on that mark of around 25,000, or the round figure that we're looking at, just a couple of percentage points away. So the bulls, they have their eyes set on that 25,000 odd mark. What do the FIs do? Well, they have been long. They continue to remain long. Close to around 16,000 of their contracts were added on the long side, and there was some mild short covering. It keeps the ratio more or less at that 80%, 20% long short ratio, the LSR ratio that we look at. Well, in terms of the absolute number, well, the FIs, they continue to remain net long, 3.3 lakh contracts on the long side. The clients, well, they have continued their short positioning at around 2.14% of 2.14 lakh contracts. But both of them have come off considerably from the recent high. But the reason I say that it appears this range has moved up because I'm looking at the options data. And remember that 24,450, 24,500, that was a bit of a resistance zone. Now, we did see a fair bit of addition at that particular level because the call writing seems to have moved up from around 24,400 to around 24,500 and 24,700 call out. So both of them were fairly active. On the downside, the put writing, 24,200 put was active. Now in Friday's trading session, we saw that base move up a little bit 24,400, 24,500 put, both of them were fairly active. So the new range you're looking at is, in fact, the markets are likely to move a little bit up. The support, since we are seeing writing at around the 24,400 put, this 24,300, 24,330 mark becomes extremely important. While on the upside, the first level you're looking at is 24,650. And then because the 24,700 call is active, the 24,750 mark becomes important. The Nifty Bank, that's facing resistance at these levels. And I say that because in the last few sessions, we're going towards that 52,700, 52,800 on. And from there, we're coming off the day's high. So you just pull up that chart, you'll see that the last few sessions, we've been visiting that mark. But the Nifty Bank, that holds the crucial number out here. Even in Friday's trading session, it came off closer to 350 points from the high point of the day. So it needs to get past that 52,800 odd mark. The stock that I'm looking at is NBCC. Well, that's been in a bull run of its own. However, on Friday's trading session, it took a bit of a break. It was down closer around 2% odd, and it underperformed the Nifty a little bit. Now, importantly, it's crossed that 20 DMA, and it's trading comfortably about those levels. So was Friday's session a bit of a pause and it wants to resume the uptrend? Or is it in for a bit of a correction? Well, time will tell. But for the time being, that stock is going to be a crucial one because it's seen a big run and it took a bit of a break on Friday.
Okay, Nigel, thanks a lot for that. Well, let's move on and get you some opinion now. On the equities front, we kickstart with Chetan Seth of Nomura, who says that another soft US core CPI almost seals a Fed rate cut in 2024. He says significant rotation seen post-soft CPI release and focus is now on whether the equity rally broadens out into laggards and value areas, at least in the very near term.
Okay, we have Samiran Chakrabarti of Citi who says that higher than expected inflation continued robust growth momentum, relatively easy financial conditions and recent comments from the RBI governor prompt them to push back their first repo rate cut called to April 2025 from October 2024. He says with monetary policy expected to be based on forward-looking data, a shallow rate cut cycle of 50 basis points can happen in early FY26.
Okay, and let's also get you some money market views and tell you how you should approach the rupee this morning. B. Prasanna of ICICI Bank says a soft inflation print and weak jobs data in the US has triggered a broad-based correction in the dollar as an early rate cut in September is getting priced in by the markets. He says the Japanese yen recovered sharply from its lows on account of unwinding of carry trades, while the Chinese yuan and Asian currencies appreciated moderately. However, he says the rupee remained an outlier and hinged around 83.50 because of the lack of trading interest in RBI intervention against flows. He expects this trend to continue and the rupee to trade in a narrow range of 83.30 to 83.60 this week. And on the bonds, V. Prasanna says the bond prices globally saw continued momentum post softer employment data and lower inflation in the US and is now pricing in a 50 basis points cut in 2024. However, he adds local bonds remain cautious amid strong growth and a sticky inflation scenario. He expects consolidation to continue ahead of the union budget on robust demand and thin supply scenario. He expects the 10-year benchmark bond yield to trade in a range of 6.95 to 7.05%.
Well, we've got a lot of stock-specific action that we're tracking for you in our special Top 10 segment. For the time being, we run you through the list. We're looking at HCL Tech, Avenue Supermarts, IRDA, Oro Pharma, Cipla, Lupin, Piramal Pharma, Alembic Pharma, Suntech Realty, and PTC Industries. That's sort of a day where all the stocks will be reacting to positive news flow.
Okay, Jeffrey Dennis is independent emerging markets commentator. He's joining us now to take some questions. Jeffrey, good to have you with us here. Thank you for your time. You know, just a quick word on the presidential race in the U.S. and if, the sort of attempted assassination of President Trump, what does it do to the race itself? I mean, elections are a little out and markets have, I don't think, started trading that one way or the other. But what is your own sense?
Well, of course, it's a shocking development, which I think everybody should regret. And there's certainly a major attempt to try to play down some of the rhetoric that is going on post this assassination attempt. I think the net of this is probably it helps Trump in the polls as sort of, if one can ever put this with respect to President Trump, ex-President Trump, a sympathy vote because of this assassination attempt. And also, I think if you look at Trump versus Biden, assuming Biden is still going to be the nominee, and I think the Trump assassination attempt takes a bit of pressure off Joe Biden short term to make his mind up about whether he's going to run or not. But I think here the net is that the market would probably prefer a Trump presidency. And therefore, at the end of the day, this is probably something that does benefit the Republicans at the margin, and therefore probably is positive for the market. But I think the real issue here is this is a tragedy for the United States, a tragedy for the Trump family, and I don't want to make too big a deal of what the market implications could be.
Okay, absolutely. This is a big tragedy. I mean, the events that have unfolded are very, very unfortunate there. But Jeff, let's get back to tracking the markets, because it's been phenomenal, the run that we've seen so far, whether it's in India or even in the US markets with the Dow hitting that 40,000 milestone. You've tracked emerging markets for the longest time. How do you see all of this playing out? Is it still, is the risk reward still in favor of investors to invest at this point in markets like India?
I do believe that's the case with respect to emerging markets. I think I've said on this channel before that one of the extraordinary things about this year is how the whole of the increase in the market, in the index, the EM index this year is down to two countries, Taiwan and India. And therefore, we really haven't had a broad-based emerging market rally. If you like, it's our version in EM of the Magnificent Seven in the US, although we're talking here about countries and not just individual stocks. Now, as we head down towards a Fed rate cut, and clearly now one is on the table, I think, for September, and I expect a second rate cut in December, that is going to continue to pull the dollar down at the margin, and that's going to push money out towards the emerging markets generally. So I'm not sure India would be the major beneficiary here because it's had a good run already, although I do like the story. But I think these events as they play out with respect to interest rates and a slightly softer economy are very positive for emerging markets, assuming the dollar continues to drift lower.
All right. Hi, Jeff. Good morning and good to see you. And you have said in the past as well that India is preferred over China. Now, if President Trump is going to make a comeback, it could make things a little bit more difficult for China. In that sense, on the equity market perspective, does it make China even more uninvestable, so to call it? We had the Q2 GDP print that came in, and irrespective of all the stimulus and all the talk, it still missed estimates.
Mm-hmm. Yes, the Chinese numbers are frankly still poor, and they're really making a very poor effort, I think, in trying to broaden growth out from exports, which remain strong, and investment towards the consumer, which is really what they've got to do as time goes on. Now, given that the focus here of growth in China continues to be mainly exports, when the Chinese economy is flooding the market, flooding the global markets with cheap production, which are products which are often being subsidized by the Chinese government. This is why the US and indeed other parts of the world, the EU, are concerned about Chinese imports and the potential, therefore, for there to be more tariffs. And so I think if Trump were to win, I think you'll get more tariffs. I think if Biden were to win, I think you may get more tariffs as well. It'll just be a more aggressive trade policy for ex-President Trump to win the election in November. Bottom line here is, despite this vast gulf in valuations between India, which is quite expensive, and China, which is quite cheap, the case is still much better, I think, for India over China, not least because China has not done the right things yet to get its growth going again on a sustainable basis, driven by consumer spending for the long term.
Okay, Jeff, we'll leave it at that. Thanks a lot for joining in and giving us your thoughts. That's the word coming in from Jeffrey Dennis, independent emerging market commentator, and his views on how to approach the markets. Let's slip into a quick break. On the other side, our list of top 10 stocks is lined up. Stay with us. Welcome back to Bazaar Morning Call. With the markets at record highs, all eyes will be on whether we can see some follow-through buying on the upside. The Nifty implied opening suggests a big opening this morning, up almost 90-odd points. And it's a big week. It's the last trading week before we head into the union budget. But we have lots of stocks to talk about, so let's get straight to it. Our research team is joining in with a list of top 10 stocks. Reema's here first up to tell us about HCL Tech and how the numbers look. Reema, over to you.
So, HCL Tech's numbers are slightly ahead of street expectations. Revenues have fallen by 1.6%, but the street was anticipating a 2% decline. The reason for the revenue drop is because one of their large projects went offshore and 2 annual productivity benefits get passed on to customers. Margin decline of 50 basis points too was slightly ahead of street expectation. But remember, the stock had run up on Friday with that monster, IT rally that we had on Friday. So perhaps some of the good news is priced in. And 2, the profit beat is courtesy of one-off other income. So profits went up 6.8%, but it's aided by an other income. The company's maintained its full-year revenue guidance of 3 to 5%. They've said Q2 will be a growth quarter. They've also maintained full-year margins of 18 to 19%. The brokerage view is mixed. CLSA downgrades, but Motilal Oswal says HCL Tech is their top pick, kept a target price of 18.50. Nomura raises EPS estimates.
Thanks a lot for that, Reema. Well, in fact, we'll get a conversation going with the management of HCL Tech on the Q1 numbers as well as the outlook at 9:30 a.m. later today. Well, the other set of numbers that came out over the weekend was DMart. The valuation-wise, the stock is not cheap, but the numbers look pretty okay, I think. Mangalam, tell us more.
Well, no problems with the numbers. In fact, some of the internals are actually quite strong. For DMart, we already knew what the standalone revenue growth would be. So the key thing that everyone was looking at in terms of numbers were the gross margins. And there has been an improvement both year on year and quarter on quarter. The company said that the product mix has increased as contribution from general merchandise has increased as well for them. So that's important. The EBITDA, however, the margins were limited largely because there were higher employee costs and other expenses. And DMart Ready, that's the second thing that we were watching. How is the online business doing? Out there, the revenue growth was 27%, and they saw a mild break even on the EBITDA as well. So overall, revenue growth of 18.5%, EBITDA growth of 18%, margins at around 8.7%, and the net profit grew at around 18% as well. And the company said the operating costs have largely gone up due to continuing effort on improving service levels and building capabilities for the future. The only thing that the street will eye now is the pace of store addition and the rate at which the company keeps on opening new stores. So that's something we'll watch out for. Improvement in gross margins is good, and the fact that they are spending on improving service levels and building capabilities is a positive as well. See mild green today because the valuations limit much upside on DMart right now.
Okay, thanks a lot for that, Mangalam. Let's go across to Ekta now. She's tracking Aurobindo Pharma, Cipla and Lupin this morning. Ekta, over to you.
Thanks for that. Well, I'll start with Aurobindo, which is in focus because they will be considering a buyback on July 18th. They have a gross cash of around 6,500 crores on their books, net cash of around 150 odd crores. Analysts say that the buyback is because, their Pen-G capex is now complete. But they're speculating that the quantum of the buyback won't be too much. It could probably even be limited to around 1,000 to 1,500 odd crores. Cipla, their Kurkum facility is classified as a VAI, voluntary action indicated, was inspected by the US FDA in May, and it was a routine inspection. Expect that stock in the green. Lupin, their Bazaar facility in Gujarat has received an EIR from the US FDA, and the plant was inspected from April 8th to April 12th with no observations. It's used for API and CDMO operations.
Okay, thanks a lot for that. So Aurobindo, Cipla and Lupin in focus. Aurobindo considering a buyback as well. But there are some more pharma stocks that you're looking at, Ekta, this morning?
Well, yes, I'm looking at Piramal because the US FDA conducted a pre-approval inspection of their Ahmedabad facility, and that was completed with 0 observations. Expect the stock to be in the green, and they have received a no action indicated status. So things are all clear for them. Alembic, they've received a tentative US FDA nod for Uptravi generic or Selexipag, which is basically an injection used to treat high blood pressure. Company says they're the sole first applicant and could be eligible for 180-day exclusivity. Could expect the stock to be in the green. But remember that it's a tentative approval that they've received.
All right, Ekta, thank you very much for that. IREDA first quarter numbers. Abhishek is here with detail. Abhishek, morning.
Well, Prashant, it was a strong AUM growth. However, operationally, it was a weak quarter with reference to PNL. And, provision write-back has hit the path this time around. So, AUM growth was at close to 34% YOY and about 6% sequentially. Quarter-on-quarter gross NPA ratio has improved to 2.2% versus 2.4% in the previous quarter, and net NPA ratio has also improved to 0.95% versus 0.99% in the previous quarter. Net interest margin has expanded both YOY and quarter-on-quarter, so 3.29 compares to 3.23% in the same quarter last year and about 2.85% in the previous quarter. So the NI growth is at 37.5% YOY and about close to 5.5% sequentially. However, the operating profits have have declined by a massive 8.9% quarter-on-quarter. There is a provision write back of about 30 crore this quarter, which compares to an expense of about close to 9-10 crores in the previous quarter. So PAT is up 30.25% YOY and about 13.7% sequentially thanks to this provision write back. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's hop across to Sonal, who's here to tell us about Suntec Realty. They had an update out there, and PTC is looking at raising some funds. Morning, Sonal.
Good morning, Nigel. Let me start with Suntec Realty. 2 consecutive quarters of good performance in their pre-sales. It had been lagging so far, but this time around, pre-sales are up 30%. Their collections have gone up by 19% as well. And it's a sequential recovery that the company has seen in terms of collections as well. For PTC Industries, they will be raising 700 crore rupees. This is via QIP. The board approved it over the weekend. So these 2 stocks will be on our radar today.
Okay, thanks a lot for that. Well, here's a quick recap of our top stocks. Stocks with positive news flow: HCL Tech, Avenue Supermarts, IRDA, Aurobindo Pharma, Cipla, Lupin, Piramal Pharma, Alembic Pharma, Suntec Realty and PTC Industries. While there are no stocks on our radar with negative news flow, but Manisha Gupta is joining in for a roundup of all the action from the commodity markets and all that we've seen overnight. Manisha, good morning.
Well, thank you for that. I'll start with the crude oil prices, where we have seen prices decline. Commodities actually have gone into a bit of a profit-taking, as we saw in the previous week, and the start of this week is no different. So after 4 weeks of gains, the crude prices fell more than a percentage point in the previous week, and that is what you are looking at in the markets right now as well. But, having said that, JP Morgan, Citi, and Bank of America, all these banks believe that the crude oil prices are headed towards $90 a barrel in this quarter, given the backdrop of hurricanes and interest rate cut expectation, and the fact that you could be looking at a deficit in case of crude in this quarter itself. Having said that, the metal prices, they have started slightly on a positive note, and this is after China industrial production data. Export numbers have come in on the stronger side, while of course the second quarter GDP numbers have come in slightly on the weaker side. But even with that, most of the metal prices, including copper, zinc, iron ore, steel, silver even, have started Asia slightly on a positive note.
Okay, thanks a lot for that, Manisha. Well, let's do one thing. Let's take a quick commercial break. On the other side, market expert Prakash Diwan will join in to discuss fundamental stock analysis. We'll also be joined by Prem Kishan Gupta, the Chairman and Managing Director at Gateway Distriparks, Parks, to discuss their business outlook. Stay tuned.
Welcome back. You're tuned into Bazaar Morning Call. Well, we've laid out all the stocks that need to track, but let's get some more fundamental analysis going. Prakash Diwan, market expert, who joins us on the show. Hi, Prakash. Good morning. Hope you had a great weekend. Plenty of sporting action as well. And as we speak, the Copa America as well is on. So that final, Argentina taking on Colombia. Let's see what's the outcome. As of now, it's pretty much even Steven at 0 apiece. But let's talk about stocks. The tech space had a beautiful run in Friday's trading session. HCL Tech participated as well, and the numbers looked a little bit better than what the street was working with. What do you do with the stock right now? Some part of that good news is in the price, but view on HCL Tech and preference in the tech space.
Good morning, Nigel. Thanks for the warm welcome. Yeah, of course, the UEFA has kept us awake till quite late, so but we're all set for the day, and I'm sure this is going to be a very interesting day and a week ahead, as Sonia said rightly at the beginning of the show. For HCL Tech, very clearly, all the good news, all the move in the stock was actually thanks to the TCS numbers. The moment TCS flagged off that turnaround, the whole this thing of semblance of some sort of green shoots coming back, all these stocks rallied, and HCL Tech did most of it on Friday itself before the numbers. Now the numbers come through, and you realize that it's all absolutely as the management has indicated earlier, whether it's margins, whether it's revenue growth. There's nothing which is out of place in that sense, even on the upside. Of course, if you look at the profit numbers, it's that JV with the State Street, they say exit, that probably brought in that one-off thing. But from here on, I think HCL Tech, given its past track record, will continue to keep finding newer ways to grow and, of course, make it profitable. Whereas the likes of TCS and Infosys will probably have a very steady state growth as compared to HCL Tech. So to answer our second question, what are the topics? I would still go with an Infosys and Wipro in this space because, of course, the numbers are still awaited. But the point is that if there is a turnaround in order booking, which is finally happening in some sort of softer way than anticipated, it will benefit the ones which are more resilient. So given the fact that Wipro has also moved ahead, Infosys probably stands a better chance at some sort of a reset the way TCS did. But HCL Tech is something which I won't be very excited about. Today, you probably see some sentimental green, but then people will set their eyes on the newer names or the other names which are anticipated in this week's numbers. So good numbers, but won't get too excited about it as yet.
Okay, won't get too excited about it. Got that. What about Reliance? Comes out with numbers on Friday, and this time around, the entire telecom basket is going to be definitely in focus because of the tariff hike, etc. But ahead of that, would you buy Reliance?
Good morning, Sonia. So Reliance is something which it's very endearing to understand the business finally getting into a stage where it's not just firing on all cylinders, but it's kind of revving up for the next level. Whether it's retail, whether it's telecom, as you rightly said, whether it's the O2C business, which was, let's say the last quarter or two has been a bit soft, hasn't been really talked about much. But my sense is that given the dominant position that it is now having on a global scale and not just the domestic markets, Reliance will see some sort of a re-rating. And then you finally are getting, with every quarterly numbers, you're getting close to the new energy business getting to take off. And if that's the state, so you've already seen a pushback of the aircraft, and now it's kind of come on the runway. Sometime it's going to announce that takeoff. And when that happens, Reliance will kind of give you that bump up, which is a re-rating, which is from the fourth business vertical. So my sense is at this level, you don't have much to lose. If there are positive triggers in terms of announcement closer to the AGM as well, you'll probably benefit. So if the numbers are okay, I think the market will see some follow-through buying in spite of this run-up that we've seen in the last month or so. But I would definitely recommend that to be a long-term hold in the portfolio. If people don't have it yet, it's still not too late. You could still buy into it with at least a 2-3 year horizon from here on.
Prakash, hi, morning. There's so much rotation which happens, right? People rotate it into IT. I was saying in the morning that IT is, the big rally, minor upgrade, EPS upgrades, but big stock rallies. Maybe it's, but Infosys is on Thursday. Maybe, that will, and if there is a big surprise there, then, the rally will look a little justified, because to me, it seems a little maybe overdone, but stocks are under-owned, etc. There are other technical factors at play. But just a quick word on what other sectors, Prakash, will shine this week that you think will be in focus, stocks or sectors, pockets,
Good morning, Prashant. No, so that's a very interesting point. While numbers will be center stage on a day-to-day basis, from a pre-budget positioning, I think the market's very clearly seeking newer areas that also offer you some sort of a valuation comfort. And the first sector that I notice here is shipping. If you look at the activity, and we spoke about this about a month back when I was talking about how the anticipated push on the maritime sector by the government is going to make such a big difference. So whether it's port operators, whether it's companies that facilitate that, whether it's shipbuilding companies, shipping lines, you name it, and this entire value chain is something which, look at a slumbering name like GE Shipping in the last 1 month. See what response you've seen, and the shipbuilders, which is Cochin and JRSC and Mazagon, they have been predominantly focused on defense contracts, but there's lots that can happen on the commercial side as well, and they will of course get a piece of that pie. But my sense is shipping is one sector that you could deep dive and figure out a lot of things that are happening, whether it's container freight stations, logistics operators around the shipping ports. So there's quite a bit happening. The second sector, Prashant, again, this is in anticipation that the government will come up with something to, buttress the earnings potential of the farm sector, the agri sector. You will probably see a comeback, and the monsoon has been fairly okay in spite of the late start or a little bit of a, stop and go kind of a start. My sense is the likes of Escorts and all of those, if you look at stocks which haven't done well, participated as yet, and have the right potential to do it. So with Kubota coming in, I think it's a full cycle that they've gone through in terms of product innovation. And that entire reset on the product mix, the kind of distribution strength that they've built over the last year or so, I can see very clearly those things kind of moving in a very significant trajectory. So you will have some re-rating from some of these names. But of course, then you have your regular stuff in terms of textiles and all of that. But then those are conjectures. I haven't seen any specific push from any of these. So maybe the railways continue to benefit, maybe the power sector continues to benefit. So you will start seeing the budgetary anticipation build up in this week, probably post Wednesday. Wednesday is the day off, but Thursday, Friday would probably be very key for the pre-budget kind of a position.
Okay, well, we'll just come back to you in a bit. We have a management joining us now, Gateway Distriparks. The stock has seen a good run in the last 1 year. It's over a 50% surge. To discuss the company's business momentum, growth outlook, expansion plans, we have Prem Kishan Gupta, who's the Chairman and Managing Director at Gateway Distriparks, joining us now. Mr. Gupta, good morning and thank you so much for joining us on the show. You know, I want to first start by just asking you how the volumes were in Q1. What was the growth that you saw in your volumes? And overall, what are you guiding for the full year? That's for FY25.
Yeah, good morning, Sonia. Thanks for having me on the show. See, the volumes are a little bit subdued. If you compare it with the previous year, Q1 and Q2 of financial year 24 were on the up, whereas the decline started from Q3 and it accelerated in Q4. And the first 2 months in Q1 also we saw some slow, low volumes. But June and July are giving us some hopes to build up those volumes. There are multiple factors. One is the Red Sea conflict is compounding, and the containers shortage and the freight rates has dampened the EXIM business. But hopefully things will revive now that the elections are over, the budget is going to come. So we expect that logistics sector will be given some boost, and the spend on the infrastructure, mainly the DFCs, which are part of which are incomplete as of now, would be completed. So we look forward to some increased volumes in the coming quarters.
Mr. Gupta, when you say volumes were subdued, can you just quantify that for us? I mean, was it in 5-6% range? Was it less than that? And for the full year, do you think you can eke out double-digit volume growth, or does that look tough as of now?
Well, if you compare the last year volumes, the volume in Q1 is down by, say, roughly 5%. But as I said, that we see some early growth in the business scenario now that the stable government is there, and new policies, and as I said, the budget, everyone is waiting for that. So overall, I mean, we are evaluating. Q1 has not been good, so but we hope that we will be able to catch up if the macros improve.
All right. Hi, Mr. Gupta. Good morning and good to see you. And Nigel on this side. You know, the street is looking at the valuation debate between Concord is re-rating, should Gateway Distriparks re-rate and narrow that bridge. So that's going to be important, and that volume number is going to be crucial. But post your numbers, maybe we'll get a little bit more out of you on that aspect. The other big deal that was announced just in the last 1 month was, JSW Infra has gone ahead and bought 70% stake in Navkar Corp for around 1,000 crores odd. How does this change the competitive intensity for a company like yours?
Well, good morning, Nigel. See, it does not change because Navkar sale is, of course, there is some CFS business and 1 or 2 ICDs in Gujarat. But it is a real estate game. I mean, they have a big piece of land which is valued around that much. So basically, the valuation of the business is much less than the overall figure that you see, which has been announced. So it does not make any change. I mean, the operations are handed over to one operator to other operator. So it does not really make any change.
All right. And just to confirm, going back to the volumes number for the first quarter, you said it was 5% lower on a year-on-year basis? There was a degrowth?
No, if you look at the overall year-on-year basis, then it will be more. But I was talking about the average of 24. Q1 was extremely good last year, but we are talking about from Q3, the volume started declining.
No, I'm saying quarter 1 of this fiscal year versus quarter 1 of last fiscal year. What was the change?
Oh, it will be in double digit.
Double-digit. Okay, so on a year-on-year basis, a double-digit growth on a year-on-year basis, or double-digit degrowth? Degrowth, right?
About 9 to 10% degrowth. Yeah.
Degrowth because of the EXIM, exposure that you have. Most of your volumes are towards EXIM, so that could explain that. Just a quick question, since you mentioned, there are various buyers for the CFS business in the market. Have you engaged with anyone? Because you have put out that strategy clearly, that rail you want to focus on, CFS you gradually want to dwindle down. So are you in conversation, and how do you see this panning out?
Yeah, so we stick with our version, that CFS business is going downhill. So we are in talks with some operators who are interested in the CFS assets. So we'll be definitely, we are not close to any deal, but that is what our focus is right now, to monetize the CFS assets and put it in rail.
Mr. Gupta, hi, morning. Have you spoken to JSW Infra?
Good morning, Prashant. No, we haven't spoken to JSW because they have already taken the position in Nhava Sheva, and we are talking to some others, not with them.
And what could be, by when could we potentially see something, I mean, the outlines of a deal? The next quarter, 2 quarters?
Yes, I mean, we can see something in the next 2 quarters, that some assets are monetized, some piece of land as well as some CFS.
And in terms of value realizable, in the ballpark, could you give us a sense?
See, it depends. If someone is interested in the whole business, means CFS business, or we have also offered some people, a particular location. So we value our overall CFS valuation, if we monetize everything, it will be close to 1,000 crores.
Okay. That's for the CFS business. I wanted to ask you about your plan for growth in Snowman Logistics, right? Because you are working towards increasing your stake in Snowman to 50%. How are we over there, and what kind of growth do you see?
Well, Snowman, the growth is really good. I mean, it is in excess of 20%. And we have some new projects in pipeline, which will be operational in Q2 and Q3. So every quarter, there will be some addition to the existing capacity that we have. So Lucknow would be ready, say, next month. Similarly, we Calcutta capacity, we are increasing, and that should be operational in Q3. And there are some other dry warehouses that we are, offering to the same customers, and the 5PL business of many companies like Tim Hortons or similar companies. We clearly see a growth.
Okay, all right, Mr. Gupta. We'll look to revisit some of these numbers post your quarterly numbers. I recall you had given us that guidance of EBITDA per quarter scaling to around 100 crores or more than that. So we'll focus more on numbers post your quarterly update. For the time being, we thank you for joining in and giving us a sense about how business is shaped up in the first quarter of this year and how things are likely to shape up from here on. Let's get back to Prakash Sivan. Prakash, we have spoken about this in the past. Gateway Distriparks actually has underperformed Concord just in the last few months. But if you look at it on a longer term, if you look at it, say, on the 18-month horizon, actually Gateway had seen some bit of a re-rating, and there is a valuation cushion as well out there. Your take on it?
Absolutely. I think, the valuation comfort that you have when you buy Gateway Distriparks, similar business, of course, very, very small scale as compared to Concord. But it gives you the comfort that this company has all the right ingredients to kind of be able to scale up. They've been a bit probably, distracted with this acquisition and trying to normalize something which was another area of logistics for them as compared to what their core competence lies in. But, if I read between the lines, it's very clear that they are looking at monetizing some of the non-core assets in their parent business to make sure that, the new business is supported with more capital allocation and accelerated growth. So if that were to happen, I think you'll probably see it play catch up. Concord has risen for reasons which are not just operational, but it's more of the premium that it attracts, the scarcity premium that it attracts Nigel. So I think it's primarily because of that, but I would still believe Gateway Distripark offers far better comfort on valuation, and you could probably still see some upsides if the numbers start kind of scaling up as anticipated, which they could. It's not something which is a big ask according to me. So quite positively disposed to this thing.
Okay, let's do one thing. Let's take a quick commercial break. Up next, we have Mitesh Thakkar and Sudarshan Sukhani joining in for some technical trades, so do stay tuned in. Welcome back to Bazaar Morning Call. So we have, about 10 minutes before the pre-opening rates kick in. Good time to invite Mitesh Thakkar and Sudarshan Sukhani on the show. Gentlemen, morning to both of you. It's been a dream run for the market. Do you think that this is something that can continue? Sudarshan, let me begin with you. What's the best strategy for the week and for today?
Yeah, good morning. Well, I'm delighted. On Thursday, I had suggested that the Nifty is ready for new highs, not necessarily on that day, but very soon. And the market has obliged us. Once we are into new highs, we can expect an index like the Nifty to continue in that path. So the trade for today, as well as probably for this week, is to buy every dip. And for positional traders, just hold on. For intraday traders, exit on rallies and then look for a dip again to go long. This is a market where you only want to go long. Keep a 150-point stop from the opening price and find an opportunity. Buy call spreads, or buy whatever ETFs, whatever you want, but go long in the Nifty.
Go long in the Nifty, all right. Well, that's a good way to put it. Buy whatever you want, but go long. Is that the kind of market we're dealing with, Mitesh, where, anything and everything that you buy, will largely be on the upside? And if yes, what's the best way to approach it now?
Broadly, I would agree to it. I think, the only short positions which we have taken in the last few weeks, and especially in the last 1 or 2 weeks, is on the PSU banking side. We have seen Bank of Baroda, Punjab National Bank, Canara Bank get into a corrective mode. But broadly, it's a market where trading long has been rewarding as the Nifty continues to make new high. Now, what I'm observing is some kind of a sectoral change from banking. I think IT is taking over the baton. And now would be a primary driver in the up move in the Nifty. So traders, swing traders must focus on IT stocks, stocks which are giving breakouts or positive crossovers. I think that's where the focus would be. And for the Nifty, the near-term targets are 24,800, 24,950. And maybe, we'll look at levels beyond that, depending upon how the bank Nifty movement shapes up. But for the timing, I think we are clearly biased on the upside.
Gentlemen, morning. Mitesh, what would you trade in terms of individual names?
I have all buy calls today, Prashant, and as I said, IT is the sector to focus upon. I have 2 IT names. Infosys is a buy with a stop at 1680 for targets of 1785. Disclaimer, I have some call options positions, so there is vested interest. And Coforge is a buy with a stop at 5,900 for targets of 6250. A buy on Manappuram with a stop at 219 for targets of 236. The stop made a fresh high after consolidation. Very strong charts here. And Dalmia Bharat is a buy with a stop below 1900 for a trading target of 2000.
If you wanted to sort of take that long through options, Mitesh, what is the best way? On IT, Infosys, yeah.
Yeah, so I have, as I said, I think, I have options in Infosys. I have other stocks where I have long option positions as well. And I think buying at the money options for most of these stocks could do well. I think all these stocks are now showing signs of a trend which has been there in force for the last few weeks and is still showing signs of continuation. So I think IT would be definitely one of the sectors where I would want to buy at the money call options.
Okay. All right. Infi, of course, numbers on Thursday. So we'll see if Infi can surprise the street in a very positive way as well. Sudarshan, morning. What would your trades be?
Well, we are watching the same charts, me and Mitesh. I also have these ID stocks. LTI Mindtree is a buy with a stop under 5,400, and Coforge again for me also is a buy with a stop under 5,800. I also have Page Industries. It's a high value stock, but if you can and if you're looking for an opportunity, this is it. Consider buying it with a stop under 39,000. And an interesting idea is Z. Z Tele. Z is a buy with a stop under 348. It's a buy on dips opportunity. Let's see if that works out. But primarily, he's right. Mitesh is right. Focus on IT.
Okay, the focus is on IT. Got that. That's Sudarshan Sukhani and Mitesh Thakkar. Chandan Taparia is also joining in, derivative and technical analyst at Motilal Oswal Financial Services. Chandan, hi, good morning. So the focus is definitely on IT, and you have Infosys coming out with numbers this week as well. Tell us, how are you feeling about the market overall, and what's the best way to approach it?
Good morning, Sonia and Prasant. Thanks for having me. So Nifty Index has been making high tops, high bottom, and index continuous winning streak for 6 consecutive weeks. Supports are gradually shifting higher, and every small decline is being bought. So we believe that this momentum could continue until Nifty holds above 24,250. We advise to continue with buy on decline stance for a next leg of rally towards 24,750 to 25,000 zone. Looking at the data setup, we have seen rise in the put call ratio. The volatility index is falling down, and the base of the market is shifting higher with hold of key moving average, which clearly indicates that bulls are having the dominance in the market. Now, talking about the Bank Nifty index that has been consolidating, we have seen slight underperformance, but the good part is that it managed to hold support of 51,750. So it needs to hold above 52,500 zone, then only the bullish stance could be there. So Nifty is holding well. Bank Nifty needs to see some follow-up action to support the broader market. Now, looking at the stock-wise, we have positive stance on the Nifty IT, and this index has been making high tops, high bottom with sustained buying interest. We have seen huge built-up of long position with put writing. Momentum is clearly visible in most of the IT name, and we have positive stance in Infosys, TCS, Coforge, Bsoft, HCL Tech. But here we would like to recommend go long on persistent system. One of the strongest chart. It has seen a breakout from its pole and flag pattern. Long built-up is clearly visible. So recommending to buy on persistent with support of 4,700 and looking for an upside target till 5,050 level. Second trading area, there is buy on Grasim. One of the strongest name in the market, holding well, respecting to its key moving averages, given a fresh breakout at the lifetime high zone. So recommending to buy with its price target of 29.70. One can keep the support of 27.90 for the long position. Last trading area, there is buy on Reliance Industry. Sustained buying interest we have seen. The stock has been respecting its key support of 3100, 3130 zone. We have also noticed the put writing and a small follow-up could lead the stock to higher zone. And I think momentum in the Reliance can take the index towards 25,000 as well. So recommending to buy Reliance with support of 3135. And here we have a target towards 3300 to 3330 zone.
Yeah, all right. Lots of IT between Mitesh and Sudarshan and Chandan. Chandan, good to speak with you. And thank you for those trades today. So activity certainly in the IT services space. We'll take a quick commercial break here. We are back with a pre-open session. We'll also have Abhishek Kumar at JM Financial to focus on IT results, what's come out, and of course what's ahead of us, and whether stocks are rallying based on hopes of a turnaround, or is it more to do with under ownership and other factors. Stay tuned. Okay, welcome back. 2 minutes to go for the pre-open session. We talk about the US inflation numbers and how that's sort of trending lower. But here in India, we got a bit of a slight surprise as compared to market expectations. Indian June CPI came in higher than the CNBC-TV18 poll. The number was 4.94%. The actual number was over 5%. My colleague Lata is joining in. Lata, does this justify the need for a slightly hawkish RBI?
Well, the Reserve Bank governor did indicate hawkishness, and I think perhaps they had some preview, some idea that the June inflation is going to be a bit nastier than people are prepared for. 5.1, our expectation was, our poll was 4.94, but on the street there were even polls of 4.8 actually. So 5.1 quite clearly is a surprise. It's a 4-month high if you want to look at trends. But the culprits, largely vegetables, 14% higher month on month. Shouldn't come as a surprise to any of us. We've all paid 120 rupees for tomatoes at least, if not more. The prices of onions, potatoes also higher. So 14% month on month and 29% year on year. It would be okay if this were the only culprit because this is a normal monsoon affair. But pulses and cereals are also higher, both month on month and year on year. And I must particularly point out pulses 16% up year on year. Cereals have a very big weight, and that's nearly 9% up year on year. So all this has made the food inflation up about 9.3, if I'm not mistaken, up year on year. And that compares with an already high 8.69 in May. One was expecting it to recede after the hot summer months. But if anything, food inflation has gone up. Now, core inflation has come in at 3.1. It's marginally higher if you in decimal point version compared to what it was in May. But it is going to get a little worse, which is not bad. I mean, you don't want core inflation to fall too much because it shows that there is no demand. But it's going to go higher because of telecom tariffs. That's not entirely, absorbed in the June inflation, but it will come in the July inflation. Some 15 basis points is the impact on the entire CPI, according to economists. Now, what this has done is it's made most brokerages, like especially Citi and ICICI Securities, PD, say that there are no rate cuts at all in 2024. And more, there are more brokerages as well. I just picked up two. The point is the bond markets may not be terribly upset with this because the governor, when he spoke to CNBC-TV18, clearly said that not just rate cut, but even talk of stance change is too premature at this point in time. So bond markets were kind of expecting this. However, bond yields will continue to react to the US yields, and that clearly distinctly lower, even lower than 4.2. So actually, all told, this is going to be very good for banks. See, banks don't like a cut in the repo because immediately all loans linked to the repo fall. But deposits fall slowly because as they reprice, term deposits. So banks are losers when there is a repo cut. However, they gain when bond yields fall because they get mark-to-market gains. So the net, this is actually a little bit of positive for banking stocks. Coming to IIP, actually, that's a good number. 5.9, it's like some 6-month high. And I'll tell you what is good about it. The good part, of course, electricity has been doing well in such a summer. What else would you expect? 13.7% higher, but manufacturing also is 4.6, and that's supported by consumption. That's what we were ruining. Consumption is not doing well in India. It's all government capex. Look at the consumer durables, 12.3. I guess a large part of it is air conditioners. And consumer non-durables, which was negative in April, has become a positive, which means probably there is a rural recovery. So I would say both these numbers are positive.
Okay, both these numbers are positive. Got that. Thanks a lot, Lata, for joining in and explaining the macros to us. Prakash Diwan is still with us, so, let's get his view in. Prakash, the big stock to watch this week is going to be Reliance, coming out with numbers on Friday. Of course, we spoke about that earlier as well. But let's talk about the other telecom player, right? Bharti Airtel, which has been doing very well up until now. Do you think that the risk reward is still favorable for some of these telecom names?
So honestly, the Bharti stock has already done so well in anticipation of this, price, this tariff hike that finally is coming. So I don't think there's much that you would see. You will only see reportage of ARPUs kind of improving at some point in time by September, and that's about it. Till there's some sort of a build up on the next round of tariff hike. And importantly, the rollout plans that Bharti has been keeping in the wings of sorts is probably going to start deciding where all they'll grow. So you have some of the circles where they're not yet very intensely present. They could probably rectify those situations, but that's all operational stuff in this, Sonia. There's nothing much on the stock that you have. And Reliance, the geo impact is something which you'll probably not necessarily see on these numbers, but it's going to be the subsequent quarter. So we'll have to wait for that. But the build up to that is very clearly going to be very positive for Reliance for sure.
Okay, all right, Prakash, just one quick word on Avenue Supermarts. The numbers Mangalam told us a little bit better than what we're working with. But even if you look on FY27 numbers, it's still trading at around 70 times. So valuations are not in favor. Your view on the stock?
I agree. So, the margins are very impressive for sure, Nigel. And what I think they're doing is from a mass market, a price sensitive, price conscious segment, they're trying to get some better experiences. You can see some of the formats trying to tweak in larger cities. But Avenue Supermart will always find this very challenging now that they've clocked some decent margins to maintain these margins. So if, let's say, these margins don't sustain in the next few quarters, the street is going to start questioning that. And that's precisely the reason why high valuations are always make the stock very vulnerable. And then technically, whether this gets into FNO and all, there's lots that's happening. So stay away. There's better things in retail as well that are popping up. But yes, if you hold it, you can enjoy the ride, continue enjoying the ride, but not buying anything afresh.
No, I was wondering, Prakash, I don't know if you have any thoughts of Nigel and Sonia, all these Insta delivery apps, right? Blinkit and Instamart, etc. Won't they impact players like DMart? Because, I mean, you're basically ordering on the fly. Whenever you need something, you order. Whereas I'm assuming that the person who goes to DMart kind of sort of, shops for the entire month, groceries or whatever. But if you do it through the course of the as you need it, I mean, there is, that big kind of, I don't know if DMart has an Insta service, but it's a question to ponder.
I'm glad you brought that out because I just had an incident recently where I needed some medical, not medicines, but medical stuff like, Band-Aids and all of that. And I was so surprised that I got it on Blinkit in less than 10 minutes at 11:30 in the night. So that's the kind of service that some of these quick commerce guys are providing, not just with food and with accessories and all of that, but even with critical things like medical devices and equipment,
and non-critical things also. I've recently found out 2 days back that you can order a printout on Blinkit.
Really?
You can give a printout, they'll deliver the...
Oh, wow.
I mean, it's just...
It's remarkable. Okay. Well, let's do one thing. We'll also move on and talk about the IT earnings because that's been in focus. Abhishek Kumar, Equity Research Analyst at JM Financial joins us now. Abhishek, good morning and thanks for joining in. What are your thoughts first on HCL Tech, the numbers, the fact that the company has maintained its revenue guidance and how you're positioned on the stock now?
Yeah, hi, good morning, Sonia. Thanks for having me here. So HCL's earnings also, like TCS, were slightly above expectations. In this case, the decline was lower than what we were anticipating. And also they did slightly better on margins. However, they have maintained the full year guidance at 3 to 5% and also for margin guidance 18 to 19%. So I think, both these results, the better than expected results is as much because of a more realistic guidance or expectation at the beginning of the year than any change in the underlying demand environment. So that's how I would view the outperformance of the result. In terms of stock, I think HCL is already trading at one standard deviation above its past 5-year mean, and because they have maintained the guidance, there's no earning upgrade. So I wouldn't really see this as a very positive in terms of stock performance. So we have a hold, and I think the current valuation are fair value on the stock.
Okay, fair value on HCL Tech. Hi, Abhishek. Good morning and good to see you in. This is Nigel on this side. I wanted to ask you about TCS because that's the one that clearly fired up the entire sector. Now, TCS used to trade at this premium in comparison to other tech names, and that's narrowed down, with the recent rally. Do you think that TCS still should command that premium, and because of that, a little bit of a higher PE multiple from here on, given that, the ratios are more favorable, the growth is likely to be better as well?
Yes, so you're right. TCS has traded at a premium to other large cap peers. But, when the demand environment improves and the discretionary spend comes back, that is when I think that premium kind of narrows. TCS is a much better play in bad times because it has a very steady ship, whether it is top line or margins. And also, in terms of just growth acceleration into FY26, we believe the acceleration for someone like an Infosys or a Wipro would be faster. TCS would be slightly lower also because the BSNL deal, which is contributing to the growth this year, will be absent next year. So that becomes a headwind. So I think, the narrow of, premium at this stage is sort of justified in my mind.
Abhishek, hi, morning. Just a two-part question. From here, what from playing the results point of view, or I mean, if we are in a bit of a move up, what are the best ways to make money? What stocks to your mind? And second, both, to my mind, both TCS and HCL Tech, they didn't really it was not a blowout number or anything. There was no real big change in commentary from the TCS management. I spoke to them, asking them specifically if they'd be willing to call out a turn in underlying demand conditions by the end of the year. Well, they were not. and of course, we know the HCL numbers now. So unless Infi on Thursday does something spectacular, do you think this is more of a tactical kind of a move that we are in, if this is that?
I would tend to agree with that. I think, and we saw this in January after the Q3 results. There were beats, and all the stocks rallied. Yeah. But it didn't translate into earning upgrades later on, and that's when we saw the correction in the stock. I think there are enough evidence that the worst is behind the sector, right? And there are no earning downgrades, material downgrades coming through. At the same time, earning upgrades are not happening. And the valuation buffer that we had maybe around April, May, that has gone away with the recent rally. So I would say that the stocks could consolidate before actually the earnings would start coming through.
Okay, thanks a lot for joining in and have a great week. That is the word on the IT space, and looks like the worst seems to be over, at least from a market standpoint. If you look at the IT stocks in pre-opening, HCL Tech is your top gainer, TCS, Wipro, Infosys comes out with numbers this week. That is also up about 1%. Tech Mahindra is also up 1%. So that's really the star of the show this morning, the entire IT space. And then you have ONGC, that was a big gainer last week as well. So 1.5% higher there. And names like up on the downside, names like Apollo Hospitals, Eicher Motors are under a bit of pressure. But Sudarshan Sukhani is joining in to give us the 9-10 call of the day. Sudarshan, what are you looking at?
What is a buy with a stop under 5,800?
Sorry, I missed that stock. Which one is it?
Coforge.
Coforge. All right. So sticking with the IT space, the mid-cap IT names. Mitesh, what about you? We can't hear you, Mitesh. You're on mute.
Yeah. I have Coforge in my list as well, but for a change, I'll go for Dalmia Bharat for a target of 2,000.
All right, Coforge, both those, both Mitesh and Sudarshan looking at Coforge, but he's also liking Dalmia Bharat. So let's do one thing. Let's just get a quick word on what's happening in the market right now. The pre-opening rates have settled a bit higher, about 0.3% higher. And in the broader markets, a couple of stocks are worth looking at. MRF actually is one stock that we're looking at this morning. So let's just take a look at how the stock is doing. I expect the stock to be in the green because MRF has announced a price increase effective 18 July. Truck tires prices have been increased by 2%. Passenger car and radial tires increase in the range of 3 to 7%. So far, there's no increase in two-wheeler tires just yet. Now, this blended price increase works to about 2% for MRF. And this is the first price increase that MRF has taken after the price reduction that we saw in March of 2024 across categories. Now, of course, the price increase is to, make good the raw material price hikes that we've seen, pass it on to the consumers. So that's a positive for names like MRF, the fact that they won't have to bear the higher commodity prices. Apollo, CEAT and JK had already taken approximately 3% increases earlier. So this entire tire space will be in focus as price increases are now being passed on to the consumer. Most of them actually holding up in the green this morning. But Ekta is joining in to tell us about Aurobindo Pharma. Ekta, over to you.
Yes.
Go ahead.
Well, yes, Aurobindo Pharma is in focus on account of, the fact that they will be considering a buyback on July 18th. Now, the gross cash on books is around 6,500 odd crores. The net cash on books is around 150 odd crores. And hence, the street is going to anticipate what they will do. One of the key reasons for them possibly considering the first buyback ever is because their Pen G capex, one of their big capexes, is now behind them. And but the quantum is probably not expected to be that much, according to analysts. It could probably be restricted to around 1,000 to 1,500 crores.
Okay, all right. Thanks a lot for that, Ekta. Well, let's go to Manglam. He's here to tell us about Zomato. Manglam.
Good morning. So there were a lot of media reports that indicated that platform fees by food delivery companies have been increased by about ₹1. So, from 5 rupees per order, it's increased to about 6 rupees. Morgan Stanley has written on it. They've said that every ₹1 increase in the platform fee helps blended take rate / contribution margins by about 20 basis points and adjusted EBITDA for the food delivery segment of Zomato by about 5 to 6%. But they've also qualified this by saying that the net impact on financials should be seen in the context of discounted prices for gold memberships that the companies offered during renewals. And this is actually a step in the right direction, not necessarily a big boost to financials, but definitely a step towards improving the operating performance of all these companies. We've seen a big move in Zomato already. and they have an overweight rating with a target of 235 rupees on the stock.
All right, Mangalam, thanks very much for that. So that's Zomato for you. We'll have more on this one as the market opens. What do we have as far as first rates are concerned? Just a couple of seconds to go for market open. We'll sort of look at some of the earnings reactions and, of course, others as well, HCL Tech and a few others, DMart and, stocks with news flow and more. So the opening bell, the first rates are on your screen. The Nifty is starting at about 24,573. It's a new high, of course. I think it's a new high. The sensex is starting higher as well with 80,700 plus. That's a 150-point gain coming through. What else? Bank Nifty is up about 90 points, 52,366, 377. So Nifty Bank was the problem child on Friday. It gave up all the intraday gains, complete sell-off, but it's starting about 100 higher. And IT index is up about 0.65% once again. So, maximum focus on IT on Friday with a near 4.5% rally in the IT index, and it's another 0.75% gain this morning to boot. So this is a good-looking screen at the word go with a 60-point gain on the Nifty.
So it is a very good opening. Very good because we've had so many days of gains, right? And now we're building on to that. So the mid-cap index is up 150 points. The advanced decline ratio is solid at almost 1,500 stocks on the advancing side. Now, Zomato is a stock that is once again at a fresh high. It's been very strong lately, and this morning as well, Zomato is sitting at a fresh high. Then you have Tech Mahindra, which is at a fresh 52-week high as well. So Tech Mahindra is gaining ground. Talking about fresh highs, Britannia at 5,800 has hit a fresh high as well. It hasn't done too much this year, but Britannia is sitting on a fresh high right now, and the market cap has almost hit 1.5 lakh crores on Britannia. Inox Wind is another one looking pretty good over there. So these are just stocks that are hitting fresh highs. ONGC is at a fresh 52-week high as well. In the broader markets, a couple of other names. On the upside, IRDA is the one that's gaining a lot of ground after very good growth that the company has reported in its AUM. And then you have HCL Tech, which is now up almost 3% post a good set of numbers. And something like a Zomato that I spoke about earlier. Geo Financial Services also looking pretty good. RCF, Hudco, Canara Bank, Yes Bank, PNB are also a couple of other stocks that are piling on the weight. So it's a good opening for the market.
Well, that's right, Sonia. A few more stocks on the broader markets that are doing well. EMS, they've got an LOA for a project worth around 140 crores from the Uttarakhand Power Corporation. So that one's opened up with a gain. EMS is up close to around 5%. Piramal Pharma, the US FDA has issued zero form 483 observations and no action indicated designation for the company's Ahmedabad facility. So that one is well up close to around 4%. Another one that's moving well is Apollo Microsystems. They have been awarded a project by the Indian Army for vehicle-mounted counter-swarm drone system. So Apollo Microsystems, that stock as well, is up and about, up close to around 5%. GET&D, they have received an order of around 490 crores from Power Grid, but initial take on that stock actually was lower. I think the stock was down close to around 3%. So just pull up that one. In fact, that's opened up a little bit lower, GET&D. The other two stocks that are doing very, very well, we have Avenue Supermarts and V-Mart, both of them flying away. Remember, they've been doing well in the last week as well. And both those two stocks, they're up and about in today's trading session. So good start to trade. The Nifty Bank is underperforming yet again, but that's going to be holding the trigger from here on. Advanced decline ratio firmly in favor of the number of stocks advancing. Prashant.
All right. It's a 65-point gain on the Nifty. 24,565 is where we are at right now. Let's just quickly look at some of the other names here which are jumping up. So I think we did mention IREDA. It's the biggest volume-led gainer, 7%. Okay, that's now 5%. IRFC is up about 5%. There is IFCI, which is up about 5-6%. HCL Tech is popping up with a 5% gain, so 1632 on HCL Tech. Oracle Financial Services has got about a 3% pop. We've got Cyient, which is up about 3.33%. I think that tire price increase, I can spot Apollo Tire with a 4% gain right now. MapMy India, which is CE Infosystems, that's up 4%, 25.21 on MapMy India. There is Safari, the luggage maker, which is up 7%, 22.72 on Safari, and it's got decent sized volumes to show for it as well. We've got Zentech, which is up 4%, 13.50, 13.51. It's done fantastically well this year. Piramal Pharma is up 4%. Shakti Pumps is back up 5%. Stocks at about 43.50 or so. And you got Raymond, which is coming up with about a 5% gain as well. So, it's a pretty decent start. Zaggle is up about 2%. EMS Limited, I can go down the list, but then volumes are a little on the lower side to begin today's session. On the downside, maybe a few other names. Asian Paints is down 2. There is Cochin Shipyard and Garden Reach Shipbuilders and GE Shipping. I mean, so the shipbuilders are all down 2.5%, but they've had such a huge move. I mean, in 2024 so far. So that's, I guess, understandable. Mazgaon is another one. Yep, same sector, but 1.75% lower on Mazgaon as well. So all of the shipbuilders, and maybe we should put these stocks up down as an alert. Eris Life Sciences is the biggest loser with a 4% cut. The biggest volume-led loser with a 4% cut as well. Najib?
Just a few more stocks. The reason that both Safari and VIP, both of them are higher, we have Investec. This could be a bit of a tailwind to both these two stock prices. They have initiated coverage on both those two stocks. On Safari, they have a target price of 2,800. On VIP, they have a target price of around 560. They're saying the industry itself will have a tailwind, and that's why they're expecting both these two stocks to do well. And just one point on Iridum, the stock listed in November, that's November 29th odd. The issue price was 32 rupees. So effectively, you've got a 10-bagger on Irida. The high of the day was more than 310 rupees odd. What a dream stock. 8 months odd. If you got allotment in that IPO, which was fairly subscribed, you'll still be getting close to around a 9.5 to around 10-bagger in 8 months. That's the market we are in.
Oh, absolutely. And, quite amazing. Vineet Samre is our market master of the day. He's head of equities at DSP Mutual Fund. Vineet, good to have you with us here on the program. Thanks for your time. Appreciate it. You just heard some of these anecdotes and trivia, right? 8-bagger, 10 months and whatnot. I mean, it's just amazing. Once in a lifetime kind of market, right? And you don't get many of these. The question is, I think most people have made money to varying degrees in terms of what everyone's situation is different, what the starting capital is, risk appetite, and how they went about it. But broadly, I think one can say very few people would have been left behind. Are we at that point, Vineet, where you start to look at, protecting what you've made, and thinking on slightly more defensive lines rather than sort of, looking at doubling and trebling your money from here? What's your sense?
So Prashant, good morning and thank you for having me on the show. I think you have very rightly mentioned that at every interval one should always be thinking about one is growth, and then after a strong growth one should be thinking of how to protect capital. And clearly, if you look at the markets last 3 months, the quality factor has done well, and this is what actually we have generally followed over long term. At some points, it has hurt as well in terms of the overall performance. But I believe that the next maybe 1 year or so, we could see focus back coming back on the quality factor, because last 2-3 years, because of growth and followed by a lot of liquidity, we saw these up moves taking place across the segment. Now, most of the market is either expensive or very expensive. You don't have stocks which are really cheap in that case. So I would say that at least be focused on quality. Till the time the liquidity is driving the returns, it's good. But in any case, there are some issues which leads to market consolidation. Then also, I think we should be in good hands is what I believe.
Okay. But this has been such a phenomenal market, right, Vineet? If you map the last 1 year, so in the last 12 months, the returns that this market has given you, the Nifty itself is up over 20%. And I don't think any other asset class, maybe 25%, any other asset class has not given you this kind of returns. Do you think it's easy to replicate this kind of move? Or do you think that now the market could head into a period of time-wise correction, consolidation, until we get the next big trigger?
So Sonia, let's look at the data. So one is, let's go by the fundamentals first. The last 3 years, the Nifty earnings actually grew by over 25%. And now we are actually looking at growth, which is, let's say, close to 14-15%, which also I think is getting downgraded gradually. people are coming down to 12-13%. So I think fundamentally, what drove decent outperformance in the market was also, on the back of very strong earnings growth, which it itself is likely to see some bit of consolidation going forward on a high base. And anyways, some parts of the economy is still not, in the best form today. So I think considering all of that, we'll have some slowdown in the growth. And from that perspective, ideally, what you mentioned, market should see some consolidation, or at least investors should moderate their growth or the returns expectations from the market. Secondly, I mean, a large part of the market move has also been a factor driven by liquidity, which is also witnessed in terms of the P re-rating versus the earnings growth. If you make a comparison of the returns, if you break them down into how much of earnings growth has led and how much P has led to the overall return, the P re-rating has played a very important factor. And hence, I believe that, going forward, P re-rating may not remain as attractive a factor for adding to growth. Earnings should, drive the incremental growth, and earnings themselves are in a sort of slow lane. So I would say that one should expect moderation, while flows continuing can do, any kind of, things, I mean, as what we've seen in the past few years. But I think as far as the expectations are concerned, we should have some moderation in the thought process.
All right. Hi, Vineet. Good morning and good to see you. And, I was just looking at the data that we get from the mutual fund industry on a month-to-month basis. And we were thumping the table with regard to the SIP flows. But if you look at cash levels, I'd say the top 20 mutual funds, well, that's gone up dramatically. We had the PPFA, mutual fund manager who joined us on the show, and they are at around 15-16%. Even Quant Mutual Fund, well, their cash levels are up nearly around 2 times in the last 6 months in comparison to what it was. Given this sort of liquidity that's coming in and the cash at various mutual funds, we're unlikely to see a big price correction. A time correction is more like it.
So, Nigel, I think the cash is just not lying in the domestic mutual funds, but also if we consider some of the international investors, they are also maybe waiting at the sidelines because, they also want to participate in the India growth story and maybe are not as comfortable in terms of the valuation. So maybe at certain price points, they would also want to look at India more holistically. So you're right. I think which is where, you don't see deep cuts, small cuts leads to, good amount of flows. I think 4th June was a big, experience of that where, after the results came out, markets ideally should have seen even sharper cuts, but it actually restricted itself at a, narrow cut. So I would say that a lot of flows which are wanting to be part of this growth story will mean that the markets will not maybe see deep cuts unless we have some very bad incident taking place. But otherwise, I think we should be overall doing well. And like you said, some time consolidation, some market consolidation should be there. But I mean, who can fight against the flows is what I can say.
Vineet, the budget is around the corner. Tell us what is your expectation. Actually, I want to know your wish list. What would you like to see happen?
No, so see,
I'm sure you have those conversations with your team as well.
Yeah.
So give us a flavor.
So I think in terms of my expectation, I would say that I'm looking at this budget from a very balanced perspective because I believe, first of all, government does have good financial wherewithal to maybe do justice to their capex, what they were doing. Also, there is a room for some amount of welfare spends, which has been one of the important reasons where we have not seen the low income level or the mid income level actually come in the overall consumption as a basket. So I would say that beyond capex, which needs sustenance, which is very important for the overall markets and the industry growth. But I think that to create a balance, we need more, broad basing of consumption taking place. The low income, the mid income should also maybe come back in terms of driving the consumption, and any particular policy which actually drives, this part of the consumption should be a welcome step is what I would imagine. On the taxation, I think there are various talks around the restructuring of the capital gains tax, rationalization of the various asset classes, bringing them all into similar periods. So I mean, all those things we'll have to see as it comes, what gets announced. But I think the capital gains tax or anything to do with the taxation on the equity is something which is going to create more sentimental volatility. But otherwise, I think in terms of the broad policies, I would want to see more broad basing of the growth matrix.
Okay, Vineet, we'll leave it at that. Thanks a lot for joining in. Appreciate your time here. That's the word coming in on the market overall, which, by the way, is holding out quite well. 24,500 is holding. The sensex at 80,700. But HCL Tech is surging on the back of its Q1 numbers, which was slightly better than estimates. My colleague Reema caught up with the management to discuss their Q1 performance, began by asking them about their annual revenue guidance. Listen in.
This guidance of 3 to 5% is something which we gave in the beginning of the year. And we did factor in the first quarter softness, which is quite similar to the previous years. And of course, Q2 is going to be a growth quarter, and Q3 is where we usually deliver peak performance. And at this point, we feel confident of the overall guidance for the year.
But you're confident about achieving that guidance, but do you think you will get to the upper end of the guidance, or is it going to be lower to middle?
We are confident of meeting a 3 to 5% guidance. No further qualifications of higher end or lower end at this point. Just one quarter is over, so probably next quarter we may fine-tune it a little bit.
Sure. One more question. You've also said that you're seeing some early signs of discretionary demand bottoming out, but it's too early to call it with certainty. What are these signs of green shoots in discretionary demand?
If you see the verticals like technology and services, we've delivered a good sequential and good year-on-year growth. And I did call out these verticals even a couple of quarters ago that the pipeline is improving, and we expect to see some good momentum on this. So that's definitely played out. But having said that, in the last 7 quarters or 8 quarters, there has been kind of differing kind of signals that we've been getting, and sometimes the ramp-ups are very short cycle and things like that. So that's why I've not called out any pickup in demand. The demand situation remains pretty much the same as what we had talked to you 3 months ago when we gave the annual guidance.
Prateek, can you explain the margin performance? It's declined by 50 basis points, and with impending wage hikes, how comfortable are you with the margin guidance, or is there a risk to it?
Good morning, Reema, and all the viewers. I think, it is pretty much along the expected trajectory. If you see even our last 2 years, the quarter-to-quarter trajectory has been, the first quarter is the weakest, around this 17% in both the previous years as well. And then it's the second quarter where we pick up to, let's say, somewhere around 18%. And then the third quarter is the peak, driven by the software seasonality, which is our most profitable segment, as you know. And then the fourth quarter is kind of near the annual average, again, just like Q2. So that's the trajectory, and we seem to be following that. Given the first quarter decline in revenues, I think 50 bips decline is pretty much par for the course. So no special comment on that.
But there is an impending wage hike which will further put pressure on your margins. So are you still comfortable with the margin guidance, or is there even a little bit of a risk as the year progresses?
So the wage hikes, last year itself was a delayed cycle, delayed by a quarter for everybody practically. So we'll have to see what we do this year. We haven't still made the decision, as we discussed on Friday as well. So we'll have to wait and see, and we'll do what it takes, pulling out efficiencies from the business and to do the right things for the employees as well.
Okay. CVK, your deal wins, the TCV, total contract value, is down 14% on a quarter-on-quarter basis. And you said a couple of deals got pushed and delayed to Q4, though deal bookings will be pretty strong going forward. What was the reason for the delay?
Yeah, I think our overall bookings came in quite in line with our last few quarter trends. We've been clocking about $2 billion of net new TCV for the last several quarters, with the exception being the Q2 of last financial year, where we had a big spike in the deal wins. This quarter, we expected it to be a little more, maybe 2.3, 2.4, and couple of deals got moved to the next quarter. It is really nothing to do with anything to do with the macro or anything like that. It is just that the logistics of getting an agreement signed got delayed, and we expect that to happen in this quarter.
And how is the pipeline compared to what it was 3 months ago?
Yeah. Pipeline remains pretty much at the same levels as what we had in the beginning of April. However, the pipeline also needs to be further qualified into the advanced stages in which deals are and things like that. So we feel a little more comfortable about improved bookings in the upcoming quarters. That's really what our takeaway from the pipeline analysis is.
Do you think this year, though, the deal wins in FY25 can be better than what we had in FY24?
I mean, you still have 3 quarters to go, and deal wins tend to be a little bit spiky in nature. So I don't want to take an overall call. But our overall expectation is we will have a better total TCV booking than what we had in the last year. At this point, it's just an expectation, but we have to see how it plays out.
So FY25 deal wins should be better than FY24. Prateek, you've also indicated the intent to hire fewer freshers this year. Can you tell us the reason why? Because hiring generally also has been subdued over the last few quarters.
Yeah, so I mean, we've called out a number of about 10,000. Last year, the fresher hiring was 12,000. So it's kind of in the same ballpark range, if you like. It's still early days, and let's say if things do become better, we could probably go over 12,000 as well. So we moderate it or monitor it across the quarters. Especially the off-campus is something that gives us flexibility to adjust those numbers in line with the growth and in line with the attrition as well.
And how is the attrition in the system? For you, the attrition picked up quarter on quarter?
I would say it is flattish. Yes, numerically, 12.8 versus 12.4 is higher, but I would say it's along that same 12 to 13 band that we have been, I think, for probably more than a year now.
CVK, coming to generative AI, because you've called out certain productivity benefits, I think 50% in BPO and testing, 10 to 30% in ADN, and up to 10% in operations. How is this going to play out? Will you have to pass on these benefits to your clients, or do you think it'll start reflecting in margins, or are you going to bid more competitively?
Yeah, I think there are multiple variables that play into the whole productivity paradigm. And I did also call out that some of these productivity goals that I talked about, it plays out over the next several years. It's going to be a journey where we start with putting together what we call as our HCL Tech AI Force platform, which can be used to derive efficiency out of everything. IT operations, business operations within an enterprise. And it's a journey, and I mean, it will give you some year-on-year productivity, which is a little higher than what we had seen in the past. I think it's largely will get passed on. That's how I see it. There will be little areas where we may get some additional benefits, where we kind of agree on a risk-reward kind of arrangements. There could be some benefits that will accrue to us.
And just one final question about the near term, because you've called out Q2 is going to be a growth quarter. So tell us your expectations. Will it be better than what we had last year, even taking into account the impact of the JV divestment and individual in sectors and geographies? What is it that you expect?
Yeah, overall, we expect Q2 to be a growth quarter. In terms of verticals, Barring financial services, we are expecting growth in all verticals. We also expect to grow in all geographies. However, two things to call out: financial services would decline because of the divestment that we had announced. And for the software business as well, it is a little bit weaker in the JAS July, August, September quarter. So I'm not calling out any specific growth percentage or want to say it's better than last year and things like that. Overall, it will be a growth quarter.
Okay, well, that's the word coming in from HCL Tech. Let's step into a quick break. On the other side, we'll put focus on the big event next week, the union budget. Sameer Kanabar of EY and Himanshu Parekh of KPMG India will be with us to discuss their tax expectations from the budget. Welcome back. Let's focus on the big event next week, which is the union budget. What are the changes expected with respect to the taxation? Will there be any income tax relief at all? Any capital gains tax on the changes on the cards? Himanshu Parekh, the partner tax at KPMG India, joins us now. In a bit, we'll have Sameer Kanabar join us as well. Himanshu, good morning and thanks for joining in. You know, this time there is a little more fiscal headroom, right? Because of the kind of tax collections that the government has got, the kind of RBI dividend that was given out as well. So on the taxation front, is there any relief that the middle class can expect? Overall, what are your expectations?
I think, yes, there is enough and more justification for the middle class to expect some relief from this budget. Now, if you see the tax regime as is applicable to individuals, you know, we have two regimes which are currently under play. One is the what we call as the old regime, which comes into play where taxpayers are entitled to several tax incentives, but with a slightly higher rate of tax. Compare that with the new regime, where hardly any tax incentives are available to taxpayers, but they have a concessional rate of tax across, you know, more liberalized slab rates as far as income streams are concerned. Now, if we look at the new regime, the basic exemption limit for individuals is pegged at 3 lakh rupees. And I think it's time for the government to relook at it and increase that from 3 lakh to at least 4 lakh rupees. Similarly, if you look at the standard deduction that is available to taxpayers, that's a mere amount of 50,000 rupees per annum. And there's a high expectation from taxpayers that that standard deduction be enhanced from 50,000 rupees to 1 lakh rupees. If the government is keen to continue with the old tax regime as well, then there are expectations of taxpayers. There's a limit of deduction available under Section 80C, which has been stagnant at 1.5 lakhs since 2014. That needs to be suitably enhanced. And similarly, the deduction available on interest on housing loan, that has been stagnant at 2 lakh rupees since several years. And there's a need to enhance that as well. So a lot of expectations as far as on the personal tax front, as far as individuals are concerned from this budget.
Okay, since a large part of our viewers are retail investors, you know, investors in the market, Himanshu, I just wanted your thoughts there because there is some expectation of allowing mutual funds to offer pension and retirement products with the same tax benefits as a lot of tax saving schemes like an NPS, for example, right? On that front, what can we expect?
Yes, that's a fair expectation, I would say. I'm not so sure whether the government will be inclined to extend that benefit to mutual funds which invest in pension schemes. But overall, I would say as far as the capital gains tax regime is concerned, there are a lot of expectations on the taxpayers to rationalize or simplify the capital gains tax regime. Today, if you see, the regime has become very complex in nature. Depending on the category of assets, the holding period thereof, or the residential status of the taxpayer, you have differential capital gains tax rates which are applicable. And this has made it a very, very complex exercise. So there's an expectation of taxpayers that the capital gains tax regime should be simplified, it should be rationalized. And the way it could be rationalized is to say, to bifurcate all assets in two classes. One is what we call as financial assets, and the second is non-financial assets. As far as financial assets are concerned, let there be a more relaxed or liberalized tax regime applicable to them. For example, on long-term capital gains tax, let the rate be 10%. On short-term capital gains, let the rate be 15%. Whereas for all non-financial assets, let the long-term capital gains tax rate be 20% with indexation benefit, and let the short-term gain be subject to tax as per normal rates. So a lot of expectations on that front in terms of rationalization of the capital gains tax regime. Then the one other important aspect in the context of capital gains tax regime is in the context of buyback of shares by listed companies. Now today, when listed companies do a buyback of shares through the open market through stock exchange route, the shareholder does not know to whom he is selling the shares. So the shareholder ends up paying capital gains tax on that. The company doing the buyback also ends up paying buyback tax on that. And in that sense, the same transaction ends up in double taxation. And therefore, there's a need out there to eliminate the applicability of buyback tax when it comes to share buyback through this mechanism.
Gentlemen, good morning. We have Himanshu, good points there. We have Samir Kanabar, who's also now joining us on the program. He's partner tax regulatory services at EY. Samir, good morning. Good to have you on the program. You know, a lot of the viewers who are watching are I think I'm not sure I'm echoing their sentiments. Of course, more tax saving through higher exemption, etc., is absolutely welcome, right? But I think the big way in which a lot of people have created money and wealth over the last couple of years is through, of course, stocks. So that has been the single biggest driver for the wealth effect, and it's been humongous. And I think that is the reason why there is a lot of sensitivity around this on taxation and how you tax stocks. Samir, should we expect, as Himanshu just mentioned, rationalization is what he spoke about, 3 different buckets, etc. What are your thoughts here?
Yeah, so, and of course, this is more if I just joined in a bit late, so my apologies, but is more from personal tax or is it more from corporate or both?
Personal taxation.
Personal. Okay. So, obviously, from personal tax, there are a lot of, I mean, if you look at pure economic data that has been released, there has been, nobody's now talking about that we need to expand the base. So we have quite a bit of taxpayers, which is around 6.5 crores. From 2 crores, we have moved to 6.5 crores. And hence now the discussions are that if we have more people paying taxes, and how do we sort of give back benefit to them? And that's where we are doing these discussions to say that, is there something that we can do more for the taxpayers and thereby increase the consumption story, give more money in the hands of the people? Couple of things that come top of the mind is essentially, if you look at ESOPs, today the ESOPs are flavor of the day. And again, we are talking more from market perspective. A lot of companies are offering ESOPs. Now, today ESOPs are being taxed on the date of exercise. If this could be extended till the date of sale, obviously it would encourage a lot of people to sort of go for the ESOPs, because paying tax upfront without realizing any value becomes a big challenge. So this is something that I think government would be seriously looking at to bring taxation of ESOP, which is there, I think, today for startups, but not for all companies. So they should try to bring it at par from the date of realization. Second is, of course, if we can either increase the slab rates from 3 to 5, or can we increase standard deduction from 50 to say 125,000 rupees or odd. That would also leave a lot of money in the hands of the people. Some of other important aspect is that, you know, the housing related changes which had come earlier, where people, you know, had to, where it is more than 10 crores, people had to sort of not been able to take full advantage of investing in a new house. Now, if this can be sort of allowed for first house or one house, and this 10 crore limit can be sort of fixated for a second or third or subsequent houses, but not for the first house, that will make a lot of difference in the hands of the taxpayers. And of course, then can you allow sort of, you know, housing loan enhancement from 2 to 3 lakhs or 4 lakhs, whatever it is appropriate, because today tax rates are quite high. Of course, we are looking at a lower tax regime, but we don't a lower interest rate regime, but we don't know when the rates will reduce. So that is something that we would be looking at more focused in a more focused manner. And of course, today you can only offset 2 lakhs of your housing property loss against your other income. If that gap can be removed and you can be allowed to set off all your housing property related losses against all your other income, then this would sort of leave a lot of money in the hands of the people.
Okay, just one final question from my end, Samir, and this is Sonia here. I think the bigger argument is how does the government broaden the tax base, right? Get more people under the tax umbrella. And on that front, what do you think the government can do?
So, and again, as I just articulated the economic data, we have moved from 2 crores to 6.5 crores, right, taxpayers. And if you have broad numbers, if you look at, there may be, how many taxpayers who have disposable income. It would be around, 25, 30 odd crores, or between 25 to 35 odd crore people who would be in the tax net. And then, of course, if you leave out the daily wage earners or contract people, then, you are around 20, 25 odd crores people. And out of that, say you're saying 6.5 crores people are paying tax. Obviously, yes, you would still want to expand the tax base, not that you would not want to. Having said that, at least today, we believe that we are in a not that kind of worse situation as we were when there were only 2 crore taxpayers. So we are still in a better situation. Having said that, if government still proposes to expand the tax base, obviously something that government want to then allow is to keep the slab rates undisturbed, but then enhance the sort of standard deduction and thereby allow people to still continue to come within the tax net because the slab rates are still lower, and then still continue to file return and thereby encourage more people. Again, one more data that is there, which has been put up by income tax authorities, is that people who were, say, below 5 lakhs, who were paying taxes has reduced from 50% to 33%. So many people have actually moved into a higher tax bracket from 5 lakhs and above. So what we can do to sort of encourage them to sort of, give more income in the disposable income in their hands is something that government should focus.
All right, gentlemen, thanks a lot for joining in. Let's see what the finance minister has in store for us in the next 1 week or so. We'll know. And post that, we'll invite both you gentlemen, Himanshu as well as Samir, to join us and give us your first take on that. For the time being, thanks a lot for joining in. Well, time to get back to our special segment then, Quarter Se Quarter Tak, where we bring you the earnings expectations from each sector. Today, the focus is on the chemical space. Sonal joins us to tell us what do we expect from there. Over to you, Sonal.
Thank you so much for that. The big question for the chemical sector is when will we see recovery? This time around, it's going to be a mixed quarter for this sector. Raw material prices have stabilized for most companies in Q1, but Red Sea issues, they are driving freight rates higher, leading to better prices for some chemicals. And the lead time for both raw material sourcing and supplies of finished goods has increased significantly. While the commentary from management suggests prices have bottomed out, but a meaningful recovery would only be seen in second half of FY25. Let's take a look at some of the names. SRF will continue to see decline in PAT both on a quarter-on-quarter and on a YOY basis. The chemical segment will see some weakness, but packaging could see some improvement. For Navin Fluorine, it would be a decent quarter YOY, but CDMO will continue to be under pressure with prices for R22 lower. Aarti Industries will see profits rising 60% YOY on a low base because discretionary demand was very low last year. Let's talk about agrochemicals now. International agrochemical market remains under pressure from Chinese oversupply and pricing pressure. And that's why UPL will continue to report a loss. While the volumes will pick up, this will be led by lower pricing. For PI Industries, growth will continue, though growth rates will come down. New products, excluding pyroxasulfone, may have been relatively subdued this quarter. The valuations will come up for you on the screen. Though we have seen substantial correction in pricing in stock prices as well, they still remain at elevated levels, somewhere between 29 to 30 times, barring UPL, which is one of the cheapest agrochemical stock and one of the biggest companies in the agrochemical space. But yes, this is what the valuation picture looks like here.
Discuss more on the Q1 expectations from the chemical space. Bhavna Israni, the research analyst at Anand Rathi Institutional Equities, is joining us. Bhavna, hi, good morning and thanks for joining in. You heard Sonal out on the expectations from the sector. Just wanted your thoughts on the chemical space. What are the 2 or 3 things you're watching out for and which are the stocks that you're most bullish on now?
Yeah. Hi, good morning, and thanks for having me on the channel. Yeah, so as Sonal said, so Q1 FY24 last year, the performance was majorly impacted due to the destocking situation and aggressive supplies from China, which overall negatively impacted the volumes and prices both in the domestic and export market last year. So given the weak base, we would see year-on-year growth for the whole chemical sector on the back of export recovery and demand pickup in some segments. So we are seeing the demand improvement in performance chemical side, like more of pigments, polymers, paint, adhesives, and oil and gas chemicals. However, sequentially, performance is going to be a mixed bag as Q4 is seasonally a strong quarter for chemical companies. So we expect few companies like Atul, Aarti, Sudarshan would show some sequential growth supported by demand pickup in the discretionary segment. So on conclusion, year-on-year growth would be strong. However, sequential performance would be mixed bag and company specific.
All right. Hi, Bhavna. Good morning and good to see you in. This is Nigel on this side. I wanted your take on UPL. That's been a bit of an underperformer in comparison to the other stocks. Valuation-wise, there is some support. I'm not sure whether you'll have official coverage on that one. But post its exclusion from the Nifty, the stock actually has done quite well.
Yeah, so on the UPL side, so we are expecting that the demand in the domestic crop protection side would be better as compared to last year's, and the monsoon is going to be good. But however, having said that, the situation in the global agrochemical market is still challenging and headwinds are there. There is this destocking situation is currently going, pricing pressure is there. So might be there would be some more quarters to gain more recovery in the segment.
Okay, all right. Also, what are your top picks? I believe PI Industries, which has been a rank outperformer, they have done some inorganic growth as well. That's one of your top buy picks. Tell us more about that. Valuations are not very cheap, so I ask you.
Yeah, so as compared to if we see other companies, yes, the valuation looks fairly priced, and there is no been major correction on the sharp correction for various names in the sector looks fairly priced on the expectation. But yes, PI Industries has delivered better in the challenging time, and we expect that the company has the growth story and the sector and the company would perform better in the going ahead. So yes, we are bullish on the PI Industries.
Okay, you're bullish on PI Industries. Any stocks that you feel that, of course, valuations across the sector are at elevated levels, but any stocks where you have certain discomfort because of valuations alone?
Yeah, so if we see that Naveen, SRF, they are trading more than 35-40 times of multiple, and the recovery is prolonged. So we are expecting that the recovery would be majorly seen in the second half of the year, and which is going to be majorly driven by the agrochemical recovery. And the China situation, we currently not know that how they are going to pan out this season. So these are the factors, yes. So SRF, Naveen, there would be some challenges considering the major mix of the agrochemical side. And they have more of the generic products.
Got it. Okay. Well, we will let you go on that note. Thanks a lot for joining in. That's Bhavna Israni tracking the chemical sector. But let's get back to the market now. It is quiet, actually, not doing too much. The Nifty is up about 50 odd points. Mitesh Thakkar is back with us. Mitesh, welcome to the show. Your views on the index now, do you see it build on to its gains this week, or do you think that we could be entering a bit of a consolidation space? And also, what are the stocks to look at now?
So good morning again, Sonia. Every time I have called for a consolidation in the last 2 weeks, it's been sideways for 1-2 days and then made a new high. I think this rotational theme still is going on, and I think the IT names will continue to do well as they are doing today, and the banks could possibly be under some pressure. So on the Nifty, I'm not sure whether we'll have an immediate consolidation because of the strength in the IT pad, and I still expect the IT stocks to go higher, though we have results coming up in most of the stocks in the coming few days, but the overall trend looks very strong on the upside. So I think the way to approach this is that try to buy Nifty on declines around supports. So anything close to about 24,400 spot levels would be a good entry point. Avoid the banking names in the short term and focus on IT names.
Any of these tire names on your radar? C8 is up 6% now. JK is up 9%. JK Tire, that is. It'll come up on your screen. Apollo Tire. You already have trades here? Sorry.
Prashant, I have two positions in tire names. In fact, there is one recommendation also. So I have positions in MRF as well as Apollo Tires. MRF, we have futures, and Apollo Tires, we have some call options. But yes, I think good breakouts being seen over here. So I have CEAT on my recommendation list. You just mentioned the stock. Keep a stop below 27.25 here. Look for targets of 28.75, which was the recent high. But I suspect eventually the pattern suggests that we might break beyond 28.75 and head towards 3,000 levels as well. So very positive bias on tire stocks. I've given my one recommendation, which is CEAT. The other one is a sell on ABB. After a long time, there is signs of profit booking happening on the capital goods stocks, and ABB and Siemens both look to give a good pullback. So from a trading point of view, keep today's high 82.60 as the stop loss for ABB and look for targets of around 79.50, 79.30.
By the way, Mitesh, these shipbuilders, Mazgaon and Cochin and Garden Reach, even GE Shipping, they're all down 3.5%, 4%. Just, chartically, because, these were in strong momentum and people would have bought them on the way up. This morning they are down. What would your recommendation be?
Prashant, I think a very, very similar charts for all these stocks and a very similar technical setup as well. All these stocks have run up very aggressively in the last 3 weeks. They're extremely overbought, and now there are first signs on the hourly, 2-hourly charts of profit booking taking place. So my idea is that if somebody has been holding long, take profits or trail your stop loss to about 3-4% from the current price, which means that take a very tight stop loss and wait for a pullback to play out, this consolidation to play out. I think you will get them at lower levels in the next few days, though the bigger trend still remains on the upside. In the short term, I think there is a good chance of a pullback.
Okay, we take a quick break on that note. On the other side, Manisha Gupta will join in to give us all things commodities. Stay tuned. Welcome back to Bazaar Morning Call. Well, let's go across to Manisha Gupta to find out what's the one commodity you need to be tracking today. Manisha, over to you.
Well, thank you for that, Sonia. I'm looking at metals as a sector because we've started Asia on a stronger note here. Last week was kind of uneven. We did not see all the metals gain up. Copper actually lost a percentage point in the previous week, but this week it has been on a firmer note and the markets are reacting to all the very positive data that has come in from China. So the industrial production at 5.3% on an year-on-year basis is higher than the estimate and has been on a stronger note as well on a month-on-month and a quarter-on-quarter basis as well. So that has been supportive. Apart from that, when you look at the China export numbers, that should come in on your screens, and that has been at a 15-month highs, 8.6% year-on-year gain coming in for that as well. So China production and export have been on the stronger side, but that's exactly where the stronger data from China comes to a halt. The imports have declined by 2.3%. So that tells you that within China, the domestic demand is not so strong, but the export demand definitely seems to be picking up. Now, when you look at the first quarter GDP numbers as well, were on the higher side. The second quarter GDP numbers have come in slightly at the lower side of 4.7%. And then the retail sales data has not been so great. Well, that's at a 17-month lows. The unemployment numbers in China also show an unchanged view there. So as I said, it's a half and half when you look at the Chinese numbers there. But because the production and the industrial data has been positive, well, that has been supportive for many of those metal prices. If you look at copper, aluminum, zinc, iron ore, steel, those prices are trading slightly in the positive right now. For copper, essentially, while of course the forecast of the demand going forward has been on the stronger side, the near-term inventories are much on the higher side. So when you look at the LME inventories, they have doubled in last 3 months. The Chinese production numbers have been up by 9.5% for the month of June. And that is the way the copper really seems to be behaving right now. Until the month of May, it was a $70 per ton of a discount to 3 months and cents of cash. Now that has gone up to $160 a ton. So that tells you that while the holding capacity and holding cost of copper has been on the higher side, it also has to do with the fact that the near-term demand on ground is not so strong. Is the reason we have seen the copper prices come off as well. So in the month of May, we saw all-time highs at $11,000 a ton. We are trading at below $10,000 at this point in time. What the markets will watch out for going forward is one, Powell testimony, well, that is today. And then it also is about China's third plenum meeting. That starts today as well. The focus is expected to be on debt and manufacturing. Well, this is a meeting that will set course for the next 5 years within China, so would be essential to watch out for.
Okay, thanks a lot for that. Well, let's talk about IRDA, which has been a big stock in focus. Abhishek is here to tell us more about that. Abhishek, over to you.
Well, strong business momentum has aided the results this time around, although operationally, if you take a look, the operating profits have declined on a sequential basis. So take a look at the AUM growth. It's at about 33.9% YOY and close to 5.5% sequentially. Quarter-on-quarter asset quality has improved, so gross NPA ratio has come down. Net NPA ratio has also come down by 4 to 5 basis points sequentially. Net interest margin has expanded both YOY and quarter-on-quarter, so net interest margin has come in at 3.29% versus 2.85% in the previous quarter. NII growth is at 37.5% YOY and about 5.5% sequentially. Now, operating profits have declined by 8.9% quarter-on-quarter. That's largely due to the fact that other income has declined on a sequential basis. There is a provision write back of 30 crore versus expense of 9.5 crore in the previous quarter, and that's aided the PAT this time around. PAT is up more than 30% YOY and about 13.7% on a sequential basis. Back to you.
Right.
Okay, thanks a lot for that. Well, I'm also watching out for some of the tyre names because there is a price increase that some of the tyre companies like MRF have announced. MRF has taken a price increase effective 18 July. This is to pass on the high raw material costs. And truck tyres have been increased by 2%. Passenger car and radial tyres have been increased by 3 to 7%. And that's why you're seeing the stock move up as well, because the company is passing on high raw material costs to consumers, and consumers are accepting it. There's no increase yet in two-wheeler tyres, so perhaps that would come as well. The blended price increase works out to 2% approximately. And this is the first price increase by MRF. Apollo, SIAT, JK have already taken approximately 3% price increases. So this is the latest that's happening in the tyre space right now. Let's step into a quick break. On the other side, in our special pre-budget show, Lata will connect with Sajid Chinoy of JP Morgan, Soumyakanti Ghosh of SBI to discuss the big budget numbers to watch out for.